Hello, everybody. Welcome to this webinar that's brought to you by Bursa Malaysia and managed by our company LifeChamp. Our webinar title today is Understanding Risk Tolerance and Investment Style, a guide to personalizing your portfolio. So my name is Shen Chu. I'm the moderator for this webinar. So in this session, we're going to learn how do we identify our risk tolerance and our investment style, and we're going to learn how we're going to personalize our portfolio based on our tolerance and our style. So before we begin, here's a disclaimer. Whatever we share in this session is only for educational purpose. In no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decision, you are solely responsible for all your investment risk. So here's our speaker for this session. He graduated with bachelor degree in finance from Coventry University, UK. He's a licensed financial planner and also a license holder for financial advisors representative from Bank Negara. He's a co-founder of EE Cameron, in which he has shares content of more than 1 million views. He has more than 12 years of investment experience and have trained more than 1,200 working adults to master the wealth growth strategy in 3 years. So he's none other than Mr. George Poh. George, good evening. How are you today?
Hi Shane, good evening, and good evening to everyone who is attending our sessions today.
All right, cool. So I'll just stop sharing my screen and hand over the control to you.
All right, thank you Shane, and good evening everyone. Now before I actually start my sharing today, can everyone see my screen? Okay, I hope that you can see it, right? If you can see it, just put in okay in the chat box for me, right? Put in okay, or just give me a thumbs up. Yes, you are right. Right. Now, today's topic I'm going to share with you, a very beginner's type of contents. But I believe this is something that very important because a lot of people, when we do investment, right, we don't really understand our risk tolerance. And often you hear people say, hey, I don't want to invest in stock market anymore because I lose money. Have you met or heard of this kind of conversation before? Your friends, they just tell you, hey, cannot lah, I just lose too much of money in the stock market. I just want to, I think I better go back to work instead I invest. Have anyone of you heard about this before? Or this actually happened to your real life? Now, if you have, then just just put in the comment for me. Okay, me. Because I just want to tell you a lot of investor out there, we actually we face this kind of situation where why our investment portfolio doesn't perform. So today I'm going to share with you how we can actually personalize our investment portfolio, according to our risk tolerance and also our investment style, right? And this is very important. Now, all right. Now the disclaimer has been shared by Shane just now. My brief introductions, and let me just go straight into the learning outcomes you're going to learn out of our today's sharing. Now, first thing, you're going to identify your personal risk tolerance level. Now, I believe in the past few webinar, I did share something about, something similar about the risk tolerance level. But today, let's just find out, your own personal risk tolerance level and also your investment style. Now, this is, something very general because I'm going to share with a lot of people here, more than hundreds over here. I'm just going to share with you a general assessment how we can actually do it. But if you need a thorough, a more detailed assessment, you can actually do it online, or you can just find some investment advisor or financial planner to help you to do a thorough or a personalized risk level assessment to yourself. Now, secondly, after we have identified our risk tolerance level and also our investment style, then we need to match it with the suitable portfolio strategies. Now, when we talk about suitable portfolio strategies, it is across different asset classes. It's not only into a single asset, but it's across different and various type of asset classes. Now, this is very important because a lot of people, they think, oh, investment is all about fixed deposit. Investment is all about stock market. Investment is all about property market. But they didn't know that actually a good portfolio, you need to have a mixture of different asset classes. Now, but how do we allocate, our money into different asset class? How do we know? Now we have to match it with our risk profile. And last but not least, if you already have your own investment portfolio, right, we need to know how to adjust it according to different, things will change, right? Maybe our investment goals will change, our preferences will change, even the market condition today will also change your portfolio style, right? Can anyone let me know what are the biggest news today? What is the biggest news today in Malaysia in investment market, or when we say in economic macroeconomic level? What is the single major news today? Fresh from oven, guys. Fresh from oven. Can anyone know? Can anyone just let me know? Yes, thank you, Lina. Thank you, David. Wow, you guys are superb. Yes, our Bank Negara just mentioned, just cut our overnight policy rate by 25 basis points. Now, when our Bank Negara, make this announcement about the OPR cut, do you think the market condition is going to change? Yes or no? Come, everybody, just give me a brief answer. Yes or no? Do you think that this OPR cut will affect the market? Exactly, the answer is yes. And with that, if you don't know how to adjust your portfolio, you don't know how to structure your portfolio, you might get hurt about it. You might get injured, with that, right? So let me quickly go into our sharing today. Now, the first topic I'm going to do today is the introduction to you. Why risk tolerance level and investment style, or why a personalized portfolio matters a lot, right? Now, let me show you this chart and this graphic over here. Whether you are a new or experienced investor, one of the biggest mistakes that people make is copying someone else's investment approach. See, I show you this photo about conservative investor, moderate investor, and also aggressive investor. I believe this is something that you will also see it, or you already seen it, before. People will share with you, hey, you are aggressive investor. You should put about 70% into equities, 20% into alternative, 10% into fixed deposit. Now, somebody, you are risk-averse person, they will tell you, oh, you are a very conservative kind of investor. You should put 70% of your money into fixed deposit. You will just allocate about 10% into stock market and 20% into alternative. Right. Now, these are others people, investment approach. Should you follow? Should you follow? Now, this is the mistake, right? We shouldn't follow. Why? Because what works for others might completely misfit your own risk profile, your lifestyle, and also your goals. I cannot simply tell you, hey, when I meet you, I tell you, hey, you, David, I think by looking at your face and also by looking at how you react, how you behave, I think you are a moderate person. Now, this is the investment portfolio for you. Now, this is something very wrong, guys. It's something very wrong. So we cannot simply do that. So how we're going to do? We're going to find out what is our risk profile, what is our own lifestyle, or what is our investment goals. Now, what does a personalized portfolio mean? Okay, a personalization, it doesn't mean that just picking some fancy products, you just handpick some investment tools, put into it, and then you tell this, oh, this is my personalized portfolio, right? A personalized portfolio simply means that your investment makes sense for you. Okay, can you, can you understand what I mean here? A personalized portfolio means that this investment is actually makes sense for you, not your friends, not your reminder, not somebody on Facebook or somebody in front of your screen right now telling you, hey, this is your personalized portfolio, right? So your investment portfolio should reflect your financial goals. Now, what are the goals that you want to achieve through investment? Can anyone name me some of the financial goals, most of the people they have when they do investment, or you have, when you do investment? What are the financial goals? Just name me some, example. Right. Let me just start with a few, right? Some people invest because they want to retire early. So their financial goals is to retire early at the age of 50 with maybe an investment portfolio of 5 million ringgit, right? This is one of the financial goals. Now, somebody, they want to start a family. Now, for them, how they're gonna achieve that? They need to do investment as well. Right? So these are, some example of financial goals that different people have. Now you need to also find out what is your investment goals. What is your financial goals? How much you need to achieve, in order for you to achieve your goals, right? Now, secondly, your investment portfolio should also reflect your risk tolerance level. Now, how much risk you can take in, how many of you here, okay, you deem yourself as an aggressive investor. Your risk level is very high. You put in me. Okay, put in me. I want to see how many of you aggressive investor, your risk level is very high. Okay, no, don't put me lah. You just put high. Just put high for me. HIGH. Okay, high. Now, another option for you. If you're not the high risk taker, how many of you think you are a conservative investor? Your risk level is actually very low. Just put in low for me. Okay, low for me. If you think you're in between, just put in middle. Okay, middle. I want to see how many of you here are the low risk taker, high risk taker, or the medium risk taker. Or surprisingly, a lot of you is actually medium, low to medium. Nobody believes that they are high risk taker. Huh? All right, interesting. Wow, I can see a lot of comments coming in. Everyone is low to middle. Nobody gonna admit they are high risk taker. Right? Let's see. Let's see. Later, I'm going to do a self-assessment with you. Now, thirdly, your investment portfolio should also reflect your investment style. Okay, so how do you define investment style? Now, some people they like to do value investing, long-term investment. Some people they like to do short-term trading, right? So these are the different investment styles that we need to also take into consideration when we personalize our portfolio. And last but not least is the time horizon. How long you have, how much time you have to achieve this goal, for you. This is also something very important because I believe I've shared this many times, in multiple occasions in this Bursa webinar as well. If you have 20 years for you to achieve your financial goals, your risk level should be higher compared to a person where, there are only 5 years left for them to achieve their financial goal. They should be more risk averse because they cannot afford to make loss, during this 5 years period time, right? So these are the 4 key things that your investment portfolio should actually take into consideration, right? And let me also tell you why I said you need to have a personalized investment portfolio. Why one size fits all doesn't work in investment, right? People always say, hey, just follow Warren Buffett lah. We buy into Warren Buffett's stock, But do you think you can always do that? Do you think? Because the Warren Buffett company is only part of his wealth, he has some other investment portfolio. Now, if you want to follow, Warren Buffett's investment portfolio, at the last scale, at a comprehensive scale, it might doesn't work for you, right? So let me show you why I said one size fits all doesn't work in investment. Because each of these individuals, they have different needs, different goals. Let me share with you. Now, this is a 25 years old fresh graduate compared to a 45 years old office lady and also a 60 years old retiree. Do you think all 3 of them can share same portfolio or not? Yes or no? I believe your answer will be a no, right? I don't need to ask. I think everyone will say no. Why? Because they have their different cash flow needs. Those in fresh grad, they need more cash flow because they just started out. Those as an office lady, 45 years old, maybe they have a family to feed. They also have cash flow issue. Now, for those in retiree, maybe they have earned a lot in the EPF, and it's time for them to enjoy their hard-earned money. right? So they don't have cash flow issue. Now, fresh grad, office lady, or the retiree, they all have different goals. They have different emotional triggers, right? So, for example, the ladies, the young ladies, on the left hand side, the fresh grad, maybe she can afford more volatility in her investment portfolio. For the one in the middle, maybe not so, right? Especially towards the 60 years old. Maybe she needs more stability. She needs income stock instead of investing into high growth stocks. So this show that actually a single investment portfolio just doesn't work for everybody, right? But truth to be told, a lot of people, especially retail investor, we just blindly follow others. We just follow blindly. People tell you, hey, this stock can buy, you go and buy. They tell you, hey, this house can also invest, you go and invest it. They say, hey, this coin can also buy, or you go and invest it. You just follow others. So you just investing blindly. So copying portfolio will lead to mismatch risk and also generate a poor long-term outcomes to your investment, right? And why this matters even more at this era than ever, okay? Because in the past, you see, okay, let me show you. In the past, most of the investors, they are generalists. What we say generalists is that they buy into blue chips, value stocks, and they hold forever. You must have heard of this story before. People tell you, hey, 20 years ago, you buy into public bank, one lot, 20 years ago, one lot is equivalent to 1,000 shares, one lot. And today's, your public bank net worth will worth more than, maybe few hundred thousand or close to a million or close to half a million. Now, this is something that people will always tell you. But can this, kind of investment portfolio or strategy still work today? Right? It doesn't work. Because why? Because today's our market has a higher volatility. Like I mentioned, today we have a OPIA card. Yesterday night we just received, yesterday we just received the letter from our, our wonderful President Trump from the US, to our Prime Minister about the increase of 1% reciprocal tariff from 24% to 25% to Malaysia's, right? Now, today's world, the market is even volatile compared to before. And that's not the only things. Nowadays, we have more social media's outreach, we have more news coming out, and this will influence our investor emotion. And so there are a lot more, investment strategies, tools, products available in the market. And that means you need clarity more than ever in today's world. That's why we need to have a personalized investment portfolio. Now, let me test your risk tolerance level. Okay, let me test your risk tolerance level. Everyone, please get ready. I may want you to type in your answer. Okay. If you are somebody, if your stock drop more than 10%, you cannot sleep. Okay. Maybe you are at a low risk tolerance level. Okay. I hope none of you actually have this kind of issue, because I believe if you are in this kind of scenario, then in the past 6 months to 1 year, maybe you cannot sleep well, right? Because the stock market is very volatile, right? And if you can tolerate some ups and downs, maybe you are in a moderate risk tolerance level. And if let's say you are totally okay, with the short terms, volatility, just believe that this will get you a long-term capital gain, then you are in a high risk tolerance level. And there's no right or wrong answer, guys. There's no right or wrong. Just need to know how you will feel, because this is the real answer of your risk tolerance. Okay. Now, so in today's our roadmap, I will share with you how to know yourself, how to know your investment style, how to build the right portfolio, and also how to adjust over time for your own portfolio. Right. Now, let me go deep into how to understand your risk tolerance level. Okay. Or how much risk are you willing to take? Or you are able to take. Okay. So before I start over with the assessment, what we call risk tolerance is actually your ability and also your willingness to endure losses. Okay, endure losses. That means how you will react, when you face investment loss, how you will feel, how the emotional, influence you will get, right? And not everyone have the, same appetite for investment for the price up and downs. Okay, and last, knowing your risk tolerance level will protect you from panic selling or overexposure into asset classes that you shouldn't invest into it, right? Now, and when we talk about risk tolerance, there's one thing that I need to let you know or remind you. You will not realize how much risk you are taking. Now, you will not realize until the market drops. That's when you will know how much risk you're actually taking or your existing portfolio carries. So at that moment, then only you know what is your risk tolerance level. So we want to avoid that to happen. Now we do it another way around. You understand your risk tolerance level first, then only you invest into the market or you adjust your investment portfolio, right? And when we talk about your risk capacity, it is not equivalent to your risk attitude. Okay, so what is risk capacity and what is risk attitude? Okay, now let me show you. Okay, risk capacity means your financial ability to take risk. Okay, it means what? You invest 1 million ringgit into stock market, but you have another 2 million sitting at your savings account. So in terms of financial ability, you are all right, because your capacity to take risk is your capacity to take risk is actually higher. Because what? You only invest 1 million ringgit out of your 3 million portfolio into stock market, and another 66% are sitting at the what we call the risk-free investment, which is the fixed deposit or savings account, right? So your risk capacity is higher. But what is risk attitude? Risk attitude means your emotional comfort with risk. Now, these are two different things. You might afford to take the risk, but mentally, you may not accept it, right? So the same example that I used just now. You have a 3 million ringgit sitting in your savings account. You take 1 million out and invest into stock market. In terms of the risk capacity, you're all right, because this is just a 33% out of your total portfolio, right? You can afford to lose it. But emotionally, when it's 1 million ringgit in the stock market drop by 10%, 15%, 20%, you cannot accept it. You cannot accept it. So this is what we call the risk attitude. Now, these are two different things. Okay, right? So let me go straight into it. What will shape your risk profile? Okay. Why we need to know that? Because in our assessment, these are something that will affect your answer. Okay, and you will get to know what is your risk profile actually is, right? So here are 5 things that will shape our risk profile. Okay, it's very simple and very easy. Everyone actually know it, right? First thing is your time horizon. The longer time horizon you have, more risk you can take. Easy, as simple as that, right? Secondly, income stability. By right, if you have a more stable income, you have a higher stable income, you have a higher risk capacity. But as I mentioned just now in the previous slide, your risk capacity doesn't equivalent to your risk attitude. Okay, your capacity doesn't equivalent to your risk attitude. Thirdly, the dependence and also your obligation. Because when we have more responsibility, our risk capacity is lower. Okay? For somebody like me, I'm a single. I'm a single in my late 20s. I have a lesser obligation compared to somebody maybe in their late 30s. They have families, they have a newborn child. So they have more responsibility than me. So the chances that they can take higher risk is lower than me, in general view. Now, just a simple example for you, right? And fourth, what is your financial goals? All right. Because different goals, we need different risk level as well. If your goal is just to get, 10 million, where you already have 9 million, do you think your risk profile is going to be a high risk taker just to earn that 1 million, which is nearly a 10% of your existing portfolio? Do you think you need to take high risk? For me, I wouldn't take so, right? I wouldn't do so. I would just stay chill, take maybe an investment in the bond or in the fixed income stocks, getting dividends, right? 1 year I can earn about 6%, 7%. That's easy for me, right? So yeah, when we have different financial goals, you need a different risk profile as well. And last but not least, the last factors to shape our risk profile is actually our personality or our behaviors. Okay. When we talk about behaviors and personality, it's not in today's slides. But what I want to share is that this is something that we view money. Somebody they view money as something great, so they love money. Some people they see money, they hate it. That might be your personality. Oh, you think money is something bad. I don't want money. So these are different kind of people, different personality towards investment, towards money, right? So these reactions will also shape your risk profile as well. And when we talk about risk profile, it's not one and all. It's actually combine all these 5 factors, and then you will create a unique risk profile that is specially to you. But this risk profile may change over time. And we need to always bear in mind that the risk profile doesn't stay with you your entire lifetime. No, it doesn't work that way. Okay, because our time horizon getting shorter. See, let's say I'm 30 years old. My goal is to get retired in 50 years old. So today I have 20 years time. Compared to you 5 years later, you have only 15 years time. Your risk profile will change. And this is an example. Now, next, I'm going to bring you guys into a risk tolerance self-assessment. Okay. At this part, I would like you to actually take out a piece of paper, or just get ready your phone with a calculator. Okay, because we're going to do a self-assessment. I think I have prepared about 5 to 6 questions. Okay, so let's see what is your risk profile level. Okay, the first question: what would you do if your investment dropped by 20% in a month? Okay, now A, you will sell everything and cut losses. If you are this kind of person, you type 1 or you add 1 into your calculator or write it anywhere, right? If you will be the second person, you wait and see, and maybe the market will recover, you put 2. Okay, you get 2 points. Or if you are the kind of person that will buy more when your investment drop by 20% in a month, you put 3. I will go through this all the questions with you. So bear with me. Okay, please bear with me. Okay. All right. You can also type into the comment box, but just add everything because I have a few more questions coming up. Right. Ready? Now, second question. How soon do you plan to use this money that you invest into the portfolio? If you need to use it within 1 to 3 years, you put 1. If you need it in 4 to 7 years, you add 2. If you need it in 8 years time or longer, okay, you add 3. Okay, this is a very simple question. That means when you put your money into the investment, how long do you plan to actually take this money out to use it? Okay, as simple as that. All right. Now, third question. Which statement best reflects your view, okay, your personal view on risk? Okay. A, if you can't sleep, if your portfolio fluctuates too much, you put 1. If you're okay with some moderate fluctuation, you put 2. And lastly, you don't mind the big swing. That means the stock can up by 10%, down by 20% if the long-term returns are better. So you put 3. Okay. Now these are the third question. These are the first three questions. I have a few more. Okay, so please bear with me. Add it out. Later I will show you your risk level. Okay. All right. Now, question number 4. What type of investment return are you expecting? A, 3 to 5% steady growth with little to no risk, you put 1. If you're looking for 6 to 10% growth with some moderate risk, you put 2. If you're looking for more than 11% growth, even if there are a chance of losses, you put 3. Okay, I will speed it up. Question number 5, which is our last question. Okay, what is your experience in investing? Okay, if you're new, put 1. If you have invested in the market before and you can handle some up and downs, put 2. If you are already very experienced and you are very comfortable with risk and actively manage your portfolio, you put 3. Okay, now I want every one of you sum up your answer, put it into the comment box for me. Okay, put into the comment box. Sum up, add question 1 to question 5. Add it up, show me in the comment sections. Okay, let me see. 11, 14, 15, 11, 12, 14, 10. Okay. Come, keep going, keep going. 10, 13, 12, 12, 14, 11. Okay, okay. Now, do you still remember the risk tolerance level that you shared with me just now? I think about 15 minutes ago. Most of you tell me you are low to medium risk. Right? Am I right? Okay, everyone can see the comment one just now. Every one of you tell me you are low to medium risk. Am I right? Okay, let me show you. Let me show you what is your answer actually mean. Okay. Now, just now, those who tell me you have a very low risk tolerance level, I will say so sorry. You lied to me. Nobody here just now I see an answer less than 7. And nobody. Everyone more than 10. Not even a person with a single digit, guys. Just now, every one of you show me your answer is more than a double digit. That means more than 10. Okay. Which you are at the highly moderate or the high level of risk tolerance level. See, you get what I mean? So, the early part I asked you, what is your perceived risk tolerance level? Everyone told me, Josh, I'm a low risk taker, I'm a medium risk taker. But your self-assessment result doesn't prove that. In fact, it is a mismatch between your risk level and also your perceived risk profile. Something interesting, guys. Something interesting. But trust me, this is something that happens every day. Because we always like to, underestimate our risk taking. And then we always assume that we are, a low risk taker. But in real life, every one of us, we are high risk taker. We invest into stock that have a huge momentum and people tell you, hey, this stock can win up more. We invest in this kind of stock, right? We don't actually do research, analyze it. We don't listen to others. We do our own research, our portfolio, invest in it. Most of people, we don't do that. Now, when we follow others, you are a high risk taker, right? Now, what does all this score means? If you're a low profile, which none of you, nobody here is a low risk taker. I will just skip the low one. I'll go straight into the moderate one. That means you're actually comfortable with some volatility. And your investment approach can be blend of a growth and also some income stocks, So those who are in your moderate level, you can always, structure your own investment portfolio with the mixture of high growth and also some fixed income. For example, bonds, for example, fixed dividend stocks, REITs, So these are something that you can actually invest with. Or for those in a high risk profile, your risk appetite should always be you are chasing for the returns, and you can tolerate some volatility. So what, your investment approach that match you might be something about small cap, team play, or some, growth stocks that you can actually put into your investment portfolio, right? Now, now this is the foundation. Understanding yourself, your risk tolerance level or your risk profile is the foundation of your investment journey. Now, once we know that, then we have to move on into the second part, which is how are we defining our investment style, right? Just now when I mentioned about personalized portfolio doesn't fit all, now let me repeat that again, because investing is also not one style fit all, right? So what is the investment style? Investment style actually refers to the approach or the strategies we apply when we select what are the stocks, asset class that we want to include in our portfolio. So it is actually a philosophy or the investment strategy that you will use. Everyone have different kind of strategy. Am I right? For me, I'm a value investor. I do long-term investment. I only invest in stocks that have high growth together with good fundamental. All right. I don't invest in stocks that don't have any fundamentals. Just simply, trade on the trend. I don't do that. Now, this is my investment philosophy, right? And this investment approach will determine what type of stocks, what type of companies you are drawn to, and your performance expectation, right? So let me show you, these are the 5 different kind of investment style, or what we say the 5 major investment styles that most of the investor practice. I just want to share with you because you shouldn't choose only one. Maybe you need different, you need a mixture or a combination of different investment styles, to shape your own investment portfolio, right? Now let me share with you what are the 5 major investment styles and what are the focus, what are the characteristics, and also which risk level is suitable to, right? Now, first one is the value investment style. This is my investment style, right? I invest into undervalued stock with low PE, high book value. For example, these are some of the characteristics that you will find it in some undervalued stock, right? And it's suitable for who, right? It's suitable for long-term investor or conservative investor. So if let's say your risk level is somewhere between low to medium, right? Value investment might be suitable for you. Or might be suitable because it has a lower volatility, the fluctuations is lower, and then it can generate, potential upside of the stock value. Now, this is something that you want to look at, right? Secondly, our second investment style is growth. Now, invest in growth investment. Now, when you are the person with growth investment style, your focus should be in the fast-growing stocks that are in the trend right now, or the business is booming, the industry is booming, right? These are something that you should look into it, right? And what are some of the characteristics of high growth stock? They are often come with high revenue or higher earning per share growth, and sometimes they don't give dividend. They reinvest all their profits to generate higher growth for you. So this is suitable for a medium to high risk investor, right? Because this is there is there is the fundamental to it, but there is still the high growth potential, on this company as well. Now, the third investment style today is the income style. That means you focus more on fixed income. For example, dividends, REITs, right? Or some stocks that can give you consistent payouts. Maybe you look into some stocks that can have dividend policy, right? So this is suitable for people who has low to medium risk profile and you are seeking for passive income, So this will be suitable for example, retiree. You have a huge sum of money, but you don't know where to invest into it, and you are low risk taker, then you can actually allocate your portfolio into this kind of investment income play. That means you look for good dividend stock, you look for good REITs company to hold on to, and then you invest into it and you receive the dividend income as your passive income every year or every quarterly, right? Now, the fourth one will be a momentum play. Now, when we say a momentum play, sometimes we don't actually look at the fundamental of the company. Sometimes we don't look at the fundamental at all. We just look at the trend. So what we do, we check the prices of it, right? We check the candlestick. We look at the momentum. So these are more suitable for those with high risk tolerance level, high risk profile. And if let's say they are traders, then this is something that is suitable for them because they need something to trade with, So they look at the volume, they look at the price, on all the candlestick, just for them to do the trading. And last but not least, the last investment style we have today is the balance type. So balance type, that means above, above all, you can actually do a diversified one. You can just a mix of it. For example, maybe a 70% of it into growth, a 30% into income, So this is what we call a balance. You need to balance out it, but not 90% in growth and 10% in income. This is still very high growth. Okay, this is still very high growth. So a balance means you need to strike a balance, between high risk towards the lower or medium risk. So this kind of investment style basically is suitable for everyone, okay, but not, I would say, not that much towards the high risk taker because they are looking for higher potential upside of the investment, right? So, after we have learned this investment style, you might ask, hey, George, can you show me some example of what kind of stocks that fall into this kind of category of all these investment styles, right? I will not share with you what are the stocks, but I will, share with you some question, for you to identify yourself, what are the stocks or type of category of stocks that you should invest into it, right? Or you can actually plan to have it in your portfolio. Now, first thing, if you are somebody who prefers stable dividend paying stocks, you are into income investment style, the fixed income investment style. If you're somebody who will get excited about the future, tech, turnaround stories, some high growth industry, you like it, most likely your investment style will be the growth one. You're in the growth investment style. And for somebody of you like me, you're looking always stick up for cheap stocks with a strong fundamentals and also some growth potential. Most likely you are the same category as me. You are the value investor. Our investment style will always be value investing, right? And if you are those who like to follow trends, you buy on breakouts. You look at the charts. By all means, you are a momentum trader. Your investment style should always be momentum, right? And if you are not sure or you prefer a mix, then you go with a balanced investment style. All right. Now, before I should move on, right? I would say your style actually comes naturally. I don't get to choose. I want to be a trader or I want to be a value investor. I don't get to choose basically because my own preferences and also my attitude or my behavior toward investment is always been very conservative or somewhere in the middle, right? I'm not the kind of people naturally who like to take risks or who like adventurous activities. So for me, this comes naturally whereby I'm a value investor. This is just something that come into my life and I think, oh, this is something click, so I become a value investor. So by investing in the market, right, you get to know more about your own attitude or your behaviors, towards investment. And from there, you will easily to understand or identify your own investment style, by understanding yourself, right? While I say I will not share with you what are the stocks in each category. Why I don't want to share with you because I want you to do the homework for me. I will show you some stocks, some companies. Can you name me what are the investment styles they are actually suitable with? All right. The first one is Maybank. Okay, can anyone tell me Maybank falls into which type of investment style? Maybank stocks. Can anyone tell me? Okay. Okay, dividend income, right? I would say Maybank falls under income and or value, right? And or value depends on what's the price or your cost that you enter. But you're right. Something in the dividend or income, right? The second one, IGB REIT. Okay, anyone of you don't know about IGB REIT? Let me share with you. They own mall and also office tower in Mid Valley. So Mid Valley is their base, okay, and they are proposing to actually acquire another mall they have. Yes, in JB. Yes. So okay, their income play exactly right. Because they are REITs, right? They are REITs, so their income play, right? Inari, okay, Inari and Morton, they are into technology industry. They are semiconductor players. What is the play that you think Inari should fall into? Okay, growth. Wow, you guys are very smart, huh? Okay, growth stocks. Now, next, Yinsen. Okay, Yinsen is in oil and gas industry. Recently, they also got news coming out saying somebody in the Western country looking to prioritize them, and then there are news coming lah. Okay, some people say value, some people say team play, thematic. Okay, now thematic falls under which part? Just now I shared about it, right? Thematic falls under which part of which category of investment style? We have growth, we have value, we have income, we have momentum, we have balance, right? So for thematic play, they often fall within the momentum investment style, or like momentum. But Yinsen, yes or no? Because Yinsen is considered a defensive stock, right? While the industry they are in is actually a thematic play, these are cyclical sector, but Yinsen as a huge company, they actually also fall under a defensive stock. So you can consider them as a value stock or a momentum stock. Depends on how you view the business. All right, how you view the business. And and last but not least, IHH healthcare. This is where hospitals, are sitting in the listed company. What are the investment style that you think IHH actually fall into? Now, I believe most of you kind of, you see, kind of have different kind of answer, right? Value, income. Yeah, you guys are correct. You guys are correct. I would not say that much into income. They are more towards value. Right? They are more towards value. Right. I believe with all these five examples, you cannot identify, right? What kind of stocks into which kind of investment style. Why we need to do that? Because we need to understand we should invest into stocks that suit with our investment style. You shouldn't invest into something that doesn't suit your investment style. All right. So a quick one. If you want to match your risk profile to your investment style, if you're a low risk taker, high likely your investment style will be income or value. If you're a moderate one, your investment style can be a mixture, a balance of value and also growth. And if you are a high risk taker, your risk profile is high, you can do some investment in thematic play, momentum, or even growth stocks. If you're a trader, go with momentum. If you're not a trader but you are a high risk taker, you can go for high growth stock. For example, technology stocks. Okay, that's the example. A general advice. To you, right? So what your current style and is it serving you? This one I want you all to reflect yourself. Just take out one stock that you have in your investment portfolio. Don't tell me. Just pick one and then think, okay, and start to think whether these stocks fall or match with your investment style. Is it aligned with your risk tolerance level? Okay, this is one of the homework I want to share with you. I want you to do that so that you understand that your risk profile and your investment style and the existing investment portfolio, does it align? All right, I want you to do that. Okay, Now, part 4, okay, in today's our sharing, we are going to match our investment strategy to our risk profile. Okay, why we need to do that? Because when your portfolio matches with your profile, you can sleep better at night. Trust me, I can sleep well every day. Why? Because I don't need to actually you know, be concerned of my investment portfolio at night. When I sleep, I'm thinking, yeah, the stock dropped 20% again today. Yeah, I will not feel that because I'm a value investor, right? I invest for long-term growth. So I will not, I would say I never experienced this kind of, emotional attack when I sleep at night. So I wish that if you're able to match your portfolio with your profile, right, you should be able to sleep better at night, right? Why many investors lose money? Just because they use wrong allocation. Why they use a long allocation? Because they are a mismatch between their risk tolerance level and also their portfolio structure. All right. So these are the reason why investor cannot sleep at night, because it just doesn't match, right? So let me share with you some of the portfolio example. You can what to say? You can refer. You can refer to. Okay, you can refer to, right? So for example, if you are a low risk taker, you invest into value and also income stocks, right? So most likely your investment portfolio will be something like this. You diversify into 30%, 40% into REITs, getting dividends, maybe 30% into bonds, you're receiving interest coupon, and also maybe another 30% into blue chips for dividend as well, right? Maybe, this is just something for you to refer to, right? If let's say you're looking to allocate your own investment portfolio to match with your risk profile. If you're a moderate risk taker, maybe you can, take 50% into blue chips, 50% into value, 30% into high growth, and another 20% into fixed income, for example, REITs, right? So it strike a balance between the high growth and also the values part of your investment strategy. So this is what we call a moderate risk. You can always refer to this. And last but not least, if you are a high risk taker, right? If you are a high risk taker, then maybe you can say, 60% into growth, 20% I go with thematic play, another 10% is small cap, and just put another 10% as my cash, for me to catch some good momentum stock in future. Now, these are high risk taker. You might want to structure your portfolio to be something like this. Okay, but bear in mind, this is just some references for you. You need to always, structure your own portfolio based on your own risk profile, your investment knowledge, your behaviors, and whatnot, right? So it's not just about what you buy, okay? It's how much you actually allocate it, right? As simple as that. Allocation, how you allocate your money, right? So I think I'll skip this slide. This one, I think I also skipped it, right? Now, a quick one. Let's do a quick fit check, okay, to see if your portfolio matches with your investment strategy and also your risk profile. Okay, this question doesn't apply to you all because just now after our self-assessment, none of you fall into the low risk category. All right, I skip this one. Next, are you 100% in dividend stock, but you are chasing fast gains emotionally? Okay, now, can anyone here, okay, let me rephrase this question, right? Any one of you here, your investment portfolio, you have more than 80% in dividend stocks. Dividend stocks, REITs, okay? Somebody, right? Say yes. Would you feel emotionally happy when you see some stocks just grow, or the prices went up a lot, you're in your investment portfolio? Will you feel happy, or you feel exciting? You feel exciting when you see one of your stock just went up by 10%, 15% in a day. no 15%. We have our limit up. We have our limit up ratio, right? Okay. Okay, somebody say yes, but looks like you shouldn't. Okay, why you have this kind of emotion, right? It basically means there is a mismatch between your risk profile, your investment style, and also your attitude toward risk. You see, because when your dividend stock went up by 10% in a day, 15%, if you feel very happy, it shouldn't be, because you are 100% or most likely you are in medium risk only, right? But you see, now this is where we do a fit check. Now, when we understand that, oh, I feel excited every time I see my stock price went up, then you know, you know, deep down, you might have some high risk tolerance appetite in you, but you just, try to be safe. You put your investment into a medium risk, right? Now we need to always check on it, right? Because emotion is just one thing, right? Risk profile and your investment style, as I mentioned earlier, it need to always match with our investment goals, our time horizon. So maybe you are at your 50s. I don't know how young you are, right? You're in your 50s, but you will still feel, excited when the share price went up. But you know that you shouldn't, right? Because you need to follow your own risk profile at that moment of time, at that period of time, right? Now, this is something just very normal. I just want you to understand how we can differentiate it out, right? And do your top 3 holdings actually reflect your profile and goals? Check your investment portfolio, especially your stock portfolio. Look at the top 3 holdings. See whether these 3 stocks are the same investment style as you should be. Always check that, right? So this is how we do a fit check, and then to understand whether our portfolio matches with our own risk profile and all that, right? And lastly, right, after we have understand ourselves, understand our risk profile, understand our investment strategy, now it's time for us to actually go into the last part of it, where adjusting our own portfolio. Okay, now why our portfolio must evolve? You see, I mentioned earlier, right? Our risk profile shouldn't stay the same along the time. It shouldn't be, because it will change. And because our risk profile will change, our goals, our needs will also change, right? And that's why our portfolio will also change. Okay, you got it now? That's why our portfolio will also change. Or we'll say it will change, or it must change, because our risk profile will change, right? So your portfolio should always reflect your stage of life. For example, I'm in my 30s. So in this stage of life, I'm single. I don't have any planning yet, to get married and whatnot, right? This stage of life is going to be different with maybe 5 years down the road later, maybe another 5 years, I started my own family, different stage of life, I have different risk profile. And at that time, my investment portfolio will definitely be different compared to now, right? So why is that so? Because everything will change over time. So we need to always adjust our portfolio accordingly, right? So let me say with just some example of a life cycle investing. If you're in the 20 to 30s, maybe you are in the high growth risk profile. So your investment portfolio will likely be growth stocks, ETF, small cap stock, thematic play. But when you are moving into your 40s, into your 50s, you wanted to balance out your risk return. So you must adjust your portfolio into blue chips, REITs, maybe a balanced one with some growth in it, right? You need to adjust it. And when you grow older, when you are in your 60s, now you no longer have a high risk profile. So what you need to do here, You need to adjust your investment portfolio into something that can generate passive income to you. REITs, bonds, dividend stocks. Now, you shouldn't invest a lot in high growth stock anymore when you are getting older, right? This is what we call a life cycle investing. Because in every stage, everything will change, right? Now, when should you rebalance? Since we are talking about adjusting our investment portfolio, when should we rebalance it, right? Okay, so when most people will only react when market crash. So when market crash, they will say, oh, it's time for me to rebalance. Okay, but don't wait until the market crash. Okay, don't wait until the market crash. Now let me show you when should you rebalance. First thing, if there's any changes in your life event, for example, single become married, married become father or mother. These are change in life event. Okay, we need to do that. Or maybe you get retrenchment. You are in the past, maybe you're earning 20,000 per month. Suddenly, MCO came. Your job, you just lost your job. From 20,000 a month, you become maybe 5,000 a month. Now, this is also an example of life event that will happen. With different income, cash flow coming in, your risk profile is going to be different, right? So if you face this kind of life event, rebalance, adjust your portfolio. Secondly, market shift. If let's say the market have shift from bull market become bear market, you should also always rebalance or adjust your investment portfolio, because you wouldn't want you have almost 90 to 100% into high risk investment, high growth stocks, while the market is in bear market. The share price will just drop higher or even more compared to the value stocks. See, so in market shift, we also need to adjust our portfolio. I believe this one I've shared during the past Bursa webinar. You can always YouTube it, search for live champ or Bursa webinar. Look for it. I believe I've shared about the market shifting and all that, right? Just look it up. And last but not least, every year we need to always review it. Why we need to review? Let me put it in a simple saying. If you review every year, then only you will know. You get to fit check your investment styles together with your risk profile. So every year, what we need to review? First thing, we need to review our risk profile. Secondly, we need to review our investment style. Is there any changes over there? And last but not least, we need to review our existing investment portfolio, because we want to know whether they are a fit to our risk profile and also our investment style. Now, that's where we should rebalance or adjust our investment portfolio, right? At least once a year. At least once a year. Okay. Now, how to rebalance effectively? I will quickly go through this. First thing, if you have a set or investment tools that's overweight in your investment portfolio and getting not healthy, sell it or reinvest in something else that will balance up your investment portfolio, right? Secondly, keep a long-term target percentage per asset class. What does it mean? Okay, it means, for example, if let's say you have your in the next 3 years, your investment portfolio, you have a target. You want to put 50% into stock market, 30% into REITs, and 20% into bonds. Always keep this target as your yearly review target, right? So at the end of the year, when you see, hey, my blue chips just went up from 50% to 60%. My REITs went down from 30 to 25%. Same goes to my bond, right? Then you need to do the rebalancing. Okay, rebalancing. Now, why we also need to rebalance? Okay, and when people do rebalance, right, they will do this thing. They will always sell the stock in losses. They will always sell the stock that is making money, while they don't want to sell the stocks that is in losses. But let me share with you. When we do rebalancing, cost doesn't matter. Price or profit doesn't matter. Is what matters here is whether this investment suits you or not. Okay, whether this investment suits you or not. If let's say it is suitable for you, for your long-term investment, Maybe you are a value investor, and this stock might in the red, but the fundamentals still there. Your long-term view on this stock is still there. Don't sell it. Okay, don't sell it. And if let's say you're investing into stocks that you think are down, the value has already been there, it's time to sell it, sell it. Even if it is in losses or it is in profit, doesn't matter because it doesn't suit your investment style anymore. Right? I like what Eugene said here. Don't cut the flowers to water the weeds. Okay, I like it. Now, last, let me go into a summary to close out our today's sharing. Thank you very much for everyone for spending your I would say nearly an hour here, more than an hour here. I want you all to put into some practice. For example, we just do a quick one, right? This investor named Amir, he's a 38 years old, married with 2 kids, middle management, stable income. His goal is to retire at 60 years old and also for his kids' education in 10 to 12 years' time. His current risk profile is moderate. His investment style is likely to be growth with some income stocks. Let's just put 70% in growth and 30% in income stocks. And his current portfolio is 70% in speculative tech stock and 30% in cash. Now, with this kind of scenario, what would you recommend Amir do? Okay, I show you again the scenario of Amir. Okay, now what would you recommend Amir to do? Does Amir current portfolio match his risk tolerance and style? Yes or no? No, huh? Okay, everyone will say no, right? Okay. Now, what asset mix would you recommend to Amir based on what you have learned today? Okay, I see somebody say reduce speculative exposure at some income stock. Okay. Anyone else? You have some recommendation to Amir? Okay, no right or wrong, no recommendation buy sell here, no financial advice here. We just want to test out what you're learning today, whether we matching our learning outcomes, right? Okay, some say put some in REITs or a 50-50 moderate. Okay, then my next question or my last question here, should he rebalance now? Yes or no? Or should he gradually rebalance it? Not immediately right now, but gradually. Okay, some say gradually, yes. Okay, right. Now, with all the answers you guys give me, right, I believe 80% of you learn what I've shared. Now, I'm very happy to see that what I've shared today about the risk profile, the investment style, and also the matching of your investment portfolio actually meet my expectation of what I want to share with you. So let me close out my today's sharing with a summary. So you have identified your personal risk tolerance level. Congratulations. You also identified or discovered your preferred investment style. I believe so, because I shared with you 5 major investment styles. And also, I hope that you have learned how to build a portfolio structure that fits you. I believe with the case study of Amir, now you have a better understanding of how we should structure our own portfolio or do the rebalancing. And you now also know how and when to adjust your portfolio over time, right? So this is the summary of it I have. If you have any question, please feel free to put into the Q&A sessions, or you can put into the comment sessions below. What you need to do after today's webinar, I would say, try to review your current investment holdings, okay, to check whether they align with your risk and your styles. If possible, if you can do it yourself, try draft your personal investment plan. If you cannot do so, find somebody like me, a financial planner or investment planner, to help you with your personal investment plan. And also always set a reminder for your annual portfolio health check. Okay, because every year we need to review our portfolio and we need to always review our risk profile, our investment style, and also our investment strategy. All right. So with that, thank you very much for attending, to listening to my sharing. I will pass this floor back to Shane for more Q&A.
Thank you so much, George, for sharing with us about risk tolerance, investment style, and how do we personalize our portfolio based on our tolerance and also our style. So, if you have any question to ask our speaker, George, you may write your question in the Q&A box. All right, so these are the to-do list after the webinar today, okay? Okay, so the first question I see on my screen is from Mohammad Shamin. So, what are the characteristics of stocks that you choose when it comes to value investing?
Okay, good question. In my own value investing, I always look for two things. In general one, I will look for two things. First thing is whether the company is is there any growth opportunity for the stocks? Okay, first thing. And second thing, is the company in a good fundamental? Another way I will say the financial of it. So is the company in the past making good growth, in their revenue, in their earnings. We are not looking for high growth, guys. We are looking for something like gradually increase or improvement in their top line and their bottom line, which is their revenue and also their profit. And that's the characteristic I will always look into it. And then after that, I will do my own research, whether the stocks is in undervalue or maybe they have some high growth potential, and then we can start to back that, or do a valuation calculation on whether, if the company fulfill their order books or they fulfill what they have, planning for the next 1 to 3 years, what will be the value? That's when we do a valuation. So after we do all these things, right, then if I think that the company is in undervalue, I would invest into it. Let me give you an example. People always think that, hey, value investing, we cannot invest into IPO, for example. I can share with you there's this one IPO. I wouldn't name the companies here. The growth is there. Yeah. The financial fundamental is also there. So when I saw this company, right, of course, the IPO price, I think, oh, this price is just standard. They're at their fair play. So after that, companies start to announce some order books. I see, with these order books, the valuation came down. The valuation become higher. Become lower because the future growth of it is higher. So that's when I see the stocks and I start to invest into it. And of course, the share price already went up by now, but I think the value is still be there. So we need to always look out for something like this, when we do investment especially in value investing. Yep.
Right. So the next question is, how about the characteristic for growth investing? Yeah.
All right. So for growth investing, also two things I will look into it. One is their past performance, their past financial performance, whether they are in high growth. So when we're talking about high growth, in the past maybe 3 to 5 years, they need to generate a CAGR of, for example, 15% per annum or 10 to 15% CAGR. This is not something very easy to achieve. It's very hard to achieve, especially in the past 5 years. Starting from 2020, we are facing MCO of the COVID-19. So highly you won't find these kind of stocks if you are taking a 5 year period, but you can also look into the 3 years period. So this is the number one thing I will look into it. Second thing will be the industry. So when we do growth stock, right, industry is very important because when the industry is not in the trend, or the industry is not in a high growth or not favored by the hot money, then you invest into it, the growth will not come. So I will always look into these two things when I do growth investment. But right now, I'm not focus more on growth investment. My focus still back to the value investment. Yeah.
Okay, so you don't see IPO stock as growth investing, but some of the
It
counter are
depends
more.
because some IPO stock, they are growth, some they are defensive, some they are value play. So it really depends on the company itself.
All right. So the next question is by Lim. If my stocks have delivered more than 100% return, right, and they have become bigger weightage in the portfolio, right? So do you recommend a rebalance?
Oh yes, my simple answer is yes to Lim. in the past 12 years, how long since in the past 12 years of my investment journey in Bursa, Malaysia, um, there are three stocks, in my history that went double. That means the gain is more than 100%. I always do rebalance. I always do rebalance because why? First thing first, it become a huge portion of my investment portfolio. Secondly, because I want to take profit. Simply say, if your investment portfolio doubled, you take out half, you just take profit or half of it. That means you are taking all your profit, or you are taking your cost back to your into your bank account, right? So the rest running out there is either your free money or they're earning extra return for you. Now, this is a simple way. Secondly, how I will view this rebalancing, right? If the stock have already fulfilled their fair valuation, it's time for you to actually take profit. No point you keep holding on to the company where the valuation is already in the fair value, right? So these are the reason why I would do rebalance if I am you.
All
Right.
right. So we have a follow-up question by Shamin. So for both styles that you described just now, growth and value investing, how do you add to your investment from time to time? Do you average up or do you average down, or you only collect those shares when it move up, or you collect it when it's going sideways? So what are your strategies?
Well, I don't think I do much on average up because valuation wise, in terms of value investing, average up is not something I would do. But oftentimes I see myself average down or average sideways. What do I mean average sideways? That means the price doesn't move down much, but the price will just stay, stable and within 10 pips or 20 pips. So that's where I will, accumulate my shares in my shares into that company. I don't usually do average up is because simply because if the price went up, that means my valuation or the margin of safety I get to play is getting lesser. And that's where I don't like to play this kind of value stocks. That's why I don't usually do average up, but I do average down. Yeah.
All right. So the next question is by Kennedy. How do you screen stocks for value, growth, or dividend classification? Is there any such screening tool?
Um, I think there are a lot of tools available. Even your own investment platform. I like to use CGS last time, and then but when we do screening, I believe most of the free tools or your own broker can do that for you, right? So you just put in some well how to structure my answer. Okay, screening is just the first stage, the first step of you getting a list of stock for you to research on, right? Screening is not the final steps. That means you cannot just screen it and then you buy all the stocks there, right? It just doesn't work that way. So screening is going to help us to filter out, all the over 1,000 stocks in Bursa Malaysia into, for example, a stock universe of only 20 to 50. Then from there, only we research on the company itself in a detailed level. So we need to look into the company background, the businesses, the financial performance, the directors, whether their financial health is healthy and whatnot, right? So let me just give you some criteria when I look for value or growth or dividend stocks. For value stocks or growth stock or dividend stock, in common, I will say we need to find you need to filter out companies that have a average their EPS or their earning per share or their revenue is in growing. That means you can filter out those that are not growing. Okay, these are the common criteria I will look into it for value, growth, and dividend. Now, for value in particular, I will increase the requirement. So in the past 3 years, the earning per share growth must be at least 15%. I will try to screen whether we have these kind of stocks in Malaysia or not, right? At least 50%. revenue also at least 15%. And then I also try to filter out whether their profit margin, okay, I try to not invest into some companies where their profit margin is lower, in a single digit territory. So I always, look into companies where their net profit margin will be higher than 10%, right? So these are the things that I will filter out. So I get a stock universe of maybe a 50 to 100. Then from there, especially for value stocks, I will look into the industry, whether is this industry I'm comfortable with. For example, if after I screen all this and I get oil and gas company, I will not study on it because I personally don't like oil and gas company. I just don't like something cyclical. So I will just skip that. So I will look into other industry whereby I think, okay, there is some value play over here. Then I start to do research, on the stock universe. So from there, you can screen out, I think, 80 to 90% of stock in Malaysia. Then you get the only few for you to research on. So these are the criteria that I always use.
All right. Thanks, George. So let's do one last question. Yeah. So his question is: so do you regularly perform fundamental analysis on every quarter or on the annual reports on the stocks that you put into watch list or the stocks that are in your portfolio?
Yes, yes. If the stock is in my portfolio or is in my watch list, I will monitor it every quarterly. And if let's say they have some announcement, for example, they get awarded with some contracts and all that, right? There's some time for you to review on it to see whether is the values there, or for is it time for us to include that into our investment portfolio. So yes, we need to always review it, and we need to always study their quarter reports, their annual reports, because quarter reports is the most recent information we can get about the company in a proper manner, right? So I think it's a must for every one of you to study the quarter reports.
All right. So that's all the time we have with George today. So I will just share my screen. Yeah, George.
Yeah, sure.
Okay.
Let me stop
S-
sharing. Okay.
Yes. Thank you. So thank you everybody for tuning into this session. So yeah, just listen to the co-founder of eCameron, Mr. George Poe.